There's a standard arrangement you accept when entering the workforce. You trade most of your waking hours, 5 days a week, for decades. In exchange, you get a promise. Somewhere around age 65, if the math holds up and your body cooperates, you get to stop. A growing community of people decided they wanted out of that arrangement. Their alternative is called FIRE, Financial Independence, Retire Early. The pitch is remarkably straightforward. Save aggressively, invest the surplus into low-cost index funds, and let compounding buy back decades of your life. Retire in your 30s or 40s instead of your 60s. The savings rate drives this mathematical engine through a dual effect on the household balance sheet. Look at what happens when a household hits a 50% savings rate. The investable surplus sharply rises, putting serious capital to work compounding. At the exact same time, the overall target number required to retire actually shrinks because the household has learned to live on half as much money. That double effect bends the time to retirement curve. Save 10% of your income starting from zero, and you're working for 50 years. Push that to a 25% savings rate, and the timeline drops to 30 years. Hit 50%, and it compresses drastically down to around 17 years. Push it to 65%, and financial independence sits roughly a decade away. Notice what is missing from this curve entirely: the actual dollar amount of the salary. A single person earning $50,000, a dual-income couple taking home $140,000, and a high earner making $300,000 are all aiming for vastly different absolute dollar targets. Yet, if they all save exactly 50% of their take-home pay, they all arrive at financial independence in the exact same 17 years. The foundational math of FIRE works exactly as advertised. It relies entirely on the ratio of your saving to your spending. The absolute size of the paycheck dictates how comfortable the journey feels, but the math pulling you toward the finish line is identical. The math is clean on paper. The median household income in the United States sits around $83,000. A 50% savings rate means living on roughly $42,000. That is difficult in many cities, but mathematically achievable for a debt-free household. Yet the actual average personal savings rate in America hovers around 3.6%. Bridging that gap requires navigating hedonic adaptation, the human tendency for a raise to get quietly absorbed into a higher baseline of spending. Income goes up, spending creeps up to match it, and the investable gap stays flat. FIRE participants combat this friction by removing the daily decision entirely. They automate their investments before the money ever hits their checking account. This conceptual diagram illustrates the psychological rewiring at play. Humans naturally experience loss aversion, feeling the pain of losing something roughly twice as intensely as the pleasure of gaining it. Usually, this makes us fear a shrinking paycheck. FIRE redirects that psychological wiring. The protective instinct detaches from consumer spending and attaches to a compounding net worth portfolio. Spending money starts to feel like a withdrawal from something you are genuinely afraid of losing. Consumer spending is soaked in social signaling: the car, the house, the subtle competition of keeping up. The FIRE subculture actively inverts those status markers. Frugality itself becomes the flex. Paying off a mortgage early, driving a 10-year-old car, and packing lunch turn into bragging rights rather than embarrassments. Hitting a 50 or 60% savings rate requires an aggressive act of behavioral engineering. The participants are deliberately overriding human consumer defaults to protect the mathematical engine driving them toward the exit. FIRE actually exists on a spectrum. On one end is lean FIRE, retiring on $30,000 or $40,000 a year in strict frugality. On the other end is fat FIRE, targeting 6 figures of annual spending to maintain a comfortable, high-income lifestyle without the job. Regardless of the target, every early retiree faces a logistical wall. A disciplined saver builds their wealth inside tax-advantaged accounts, like a 401k or traditional IRA. Withdraw money from those accounts before age 59 and a half, and you generally owe a 10% penalty on top of ordinary income tax. Retiring at 35 requires a way to access money that is legally locked up for another 2 decades. This staggered schematic lays out the primary workaround, the Roth conversion ladder. Money converted from a traditional IRA into a Roth IRA can be withdrawn tax and penalty-free after a specific 5-year maturation period. An early retiree converts a chunk of their traditional savings into a Roth account, pays the standard tax, and lets it season for 5 years. They use a standard taxable brokerage account to survive that initial 5-year bridge. Once the gap closes, a new layer of capital becomes available for withdrawal every single year. With access solved, the entire plan hinges on one variable: how much you can safely withdraw. Back in the 1990s, financial planner William Bengen and researchers at Trinity University tested decades of historical market data and found that a 65-year-old could safely withdraw 4% of their portfolio, adjusted for inflation, over a 30-year retirement without running out of money. This bar chart exposes what happens when you stretch that rule past its breaking point. The original researchers built their math for a 30-year horizon. A 35-year-old FIRE retiree is demanding their portfolio survive 50 or 60 years. When you extend the identical methodology to a 50-year horizon, the safe withdrawal rate drops to roughly 3.5%. On a $40,000 a year lifestyle, lowering the withdrawal assumption means your target jumps from an even $1 million to $1,140,000. That $140,000 gap is the horizon crack. An entire ecosystem of calculators and spreadsheets rests on a mathematical rule never stress-tested for the actual life expectancy of the people using it. Even if the withdrawal math is perfect, a quiet risk hides inside the order of returns. Picture two people retiring with exactly $1 million. Both withdraw $40,000 a year. Both experience identical average returns over a 5-year window: 4 years of positive 8% growth and 1 year of a 20% decline. The only difference is timing. If the 20% decline hits in year 1, the retiree takes their withdrawal from a shrinking portfolio, permanently destroying shares that will never get the chance to recover. A 65-year-old with Social Security can reduce their withdrawals to cushion the blow. A 38-year-old with no other income locks in massive losses at precisely the moment their portfolio is most exposed. Sequence of returns risk stacks directly on top of current market conditions. The Shiller-Cape ratio, comparing stock prices to a decade of inflation-adjusted earnings, currently sits at historic highs, trading at more than double its historical norm. The only other time it reached these levels was the peak of the dot-com bubble. Elevated starting valuations strongly predict lower average real returns over the following decade, creating a massive headwind for anyone starting a 50-year withdrawal period today. Market downturns are a familiar risk. The single most volatile threat to a FIRE plan comes from a building completely outside the investor's control. American health insurance comes bundled with a job. Retiring at 40 creates a 25-year gap to bridge before Medicare eligibility begins at 65. This visualization tracks the Affordable Care Act income cliff. For years, early retirees lived off modest portfolio withdrawals and qualified for substantial federal premium subsidies. When enhanced subsidies expired, the strict income cliff returned. If a couple crosses a specific adjusted gross income threshold, even by generating necessary capital gains from index funds, the subsidy doesn't shrink gradually. It instantly vanishes, leaving them to pay the full 5-figure annual cost of healthcare entirely out of pocket. Sequence of returns risk is a matter of bad luck. The healthcare cliff is a matter of policy. It proves that a single, sudden legislative decision in Washington can completely shatter the most disciplined personal spreadsheet overnight. FIRE originated in the early 1990s as a quiet, anti-consumerist philosophy. Decades later, it exploded into the mainstream press, largely popularized by high-earning tech professionals who had the disposable income to push the math to its absolute limits. As thousands of people actually hit their target numbers, a genuine psychological crisis emerged. They call it one more year syndrome, the lingering fear that the spreadsheet can't quite safe enough, keeping people at their desks long after they reach financial independence. Underneath the financial fear is a quiet structural void. Many realized too late that their job was providing identity, social contact, and a reason to get up in the morning. A 25x multiple calculates your expenses. It does not calculate your purpose. Here we have a split-screen comparison of the entire equation. On the left is the clean, optimistic model you see online, a simple 4% withdrawal rate, smooth average returns, and a quick 17-year exit. On the right, we layer in the realistic demands. You drop to a 3.5% withdrawal rate for safety, build a cash buffer to survive early market downturns, and add a massive line item for unsubsidized healthcare premiums. Notice the extra capital and buffer space required on the right. A lean FIRE household living on a razor-thin budget has almost no slack to absorb these shocks. A fat-fire household spending six figures survives the stress test naturally because they have discretionary spending they can easily cut if the market drops or policies change. Achieving FIRE does not mean escaping the system. A traditional employee unconsciously outsources a huge amount of risk, market volatility, longevity, healthcare, to their employer and the government. Retiring early means voluntarily pulling all of those risks back onto your own personal balance sheet. You are trading certainty for time. For the people who build in enough margin and find a genuine purpose waiting for them on the other side, it is the best trade they will ever make.